morning, everybody. I hope you can all hear me. I'd like to welcome you today, our Compass Private Wealth clients and also our Professional Referrals Network, to our Global Investment Market webinar. For those of you who don't know me, my name is Angela Brown and I'm a financial advisor here at Compass Private Wealth. Just before we begin the webinar, I'd like to just run through some housekeeping with you. So first of all, there is a questions icon where questions can be submitted throughout the webinar. The webinar itself is recorded, so slides will be made available once the webinar is complete, and we'll also be sending along a short feedback form, and we'd greatly appreciate if you could take the time to complete this, as all feedback is appreciated. So we're joined today by two guest speakers, Jonathan Sheehan of Compass Private Wealth and Ian Slattery, investment consultant at Zurich. Jonathan will commence the webinar today by providing a recap on the market in 2020. Ian will then speak about the market performance in 2020. The webinar itself is divided into 6 themes, and Jonathan and Ian will discuss that, 6 themes for 2021. There'll also be a brief summary and a short Q&A session at the end. I'd also like to announce that Compass Private Wealth will be running a series of webinars throughout 2021. There will be 10 webinars, and each webinar will focus on a different financial planning theme. However, we will be taking a break in August and December. So we'll be sending out further details in due course each month on the webinars. Our February webinar will focus on retirement funding, and it will take place on Thursday, the 18th of February. We'd love to see you all there, so keep an eye on your emails. Without further ado, I'll pass it over to Jonathan to commence the webinar. Thank you.
Thank you very much, Angela, and delighted that you're all here to join us today. So I'm going to speak about investment markets at a high level throughout 2020 before I pass on to Ian to talk about the more nuts and bolts of it. So when we look at the main asset classes, I've split them into 5 distinct areas to touch on. Interest rates, which I'll speak about in one of the themes later, but we're at globally historically low interest rates at the moment. What that means is that the risk-free rate of return is now 0 at best. The next asset class, which we've seen huge yield compression in, is bonds or fixed income. And that's as a result of quantitative easing by central banks and lower yields available all around. Throughout 2020, we saw absolutely unprecedented volatility, something that I have never experienced in my 15 years in investment management, and something that hopefully I'll never experience again for the rest of my career. It's been quite extraordinary what we went through, and a picture does paint 1,000 words, and thankfully I do have a couple of graphs to show you the extent of the volatility that we experienced in equity markets. Property, I suppose how I would describe property is that there's been a large disparity of returns. Residential property in Ireland actually remained resilient and finished 2020 in positive territory, mainly as a result of surplus savings amongst would-be buyers in Ireland, and also a supply issue. Commercial property was very sector dependent. So obviously high street retail on Grafton Street, one would expect a capital value of those types of properties, retail bricks and mortar properties, to have fallen significantly, whereas other types of logistical warehouse type properties would have actually outperformed in 2020. And then commodities, I mean, it's unfair maybe to categorize gold and all the other types of maybe industrial production type commodities as one general asset class. What we did see in 2020 was that gold was a safe haven and actually did very well, and other commodities such as oil and the more industrial type of commodities would have underperformed in 2020. Just with commodities, when people talk about the price of gold, remember 2 things. Gold is denominated in dollars, and we'll show you in a minute the weakening of the dollar in 2020. And also commodities by nature don't generate an income. They don't generate a dividend like a company would. I said a picture paints 1,000 words. Well, this chart illustrates the 7 major indices, global stock market indices, that are most relevant for Irish investors. We'll obviously be sending out these slides after the webinar, so you can study them in more detail afterwards. So the first thing we saw was that the early part of 2020 saw a continuation of the positive markets in 2019. That came to an abrupt end on about the 22nd of February, and Ian will talk about the level of the sell-off that we experienced in that 4 weeks. So you'll see here the 7 indices all fell pretty much in unison. Later in the spring, then we saw a sustained medium-term recovery, because ultimately investors and markets said, well, policymakers, central banks, governments have promised to do whatever it takes to fix this, and that gave market reassurance. In fact, this chart would make one think that that the COVID issue was over-exaggerated. Not at all. In fact, as 2020 went on, unfortunately, the COVID virus got worse and more people died and more infections, and it probably worsened more so than the expectations. But that was counterbalanced against a huge stimulus program by central banks and governments that countered the negatives of COVID. We then, towards the end of the summer, we saw strength of the euro that hampered returns for, I suppose, euro-based investors, and I'll show you a chart in a minute as to the dollar versus the euro in particular. And then towards the fourth quarter, we did see another boost to markets, a further recovery on the basis of the vaccine exceeding everyone's expectations in terms of when it became available, and also a relatively muted US election, in that I think markets reacted positively to Biden getting in. This chart shows the dollar versus the euro over the last 5 years. Now, I know I'm recapping 2020, but I've shown the 5 years here. Firstly, if we look at the right-hand side of the chart, the extent of the weakening of the dollar versus the euro was quite incredible throughout 2020. And I think it's slipped under the radar a bit because everybody was so obsessed with the US election and with Brexit and with COVID numbers. So we still are only going back to nowhere near the weakness that, if you recall, at the early 2018 of where the dollar had been. So this 5-year chart hopefully is good to illustrate the level of volatility we've seen within the euro-dollar range over the last 5 years. Sterling is particularly relevant because Brexit, believe it or not, was almost 5 years ago now, in July 2016, when we had the referendum in the UK. Now, if you see on the left-hand side of this chart, the extent of the sell-off or the weakening of sterling in the few months after the Brexit referendum, because it took everybody by surprise, if you remember. And even though in the last 4 years, say from the beginning of 2017 to where we are now, the beginning of 2021, even though we've seen a significant amount of highs and lows, which are always expected with investment markets, by the way, we're still thereabouts the same level, you know, hovering around the 90p mark versus the euro over the last 4 years. So, you know, sterling seems to be range bound at the moment ever since the referendum of mid-2016. So now I'm going to hand over to Ian Slattery, and Ian's going to speak about the more nuts and bolts of what we experienced in 2020.
Perfect. Thanks, Jonathan. I think you might have to turn my video on. Yeah, perfect. Good morning, everyone. My name is Ian Slattery. I'm from Zurich. Delighted to be here today. So I just kind of whistle-stop tour just to build on some of the pieces that Jonathan has already discussed. But I kind of just thought I'd start with a few definitions. The likes of myself are guilty of throwing out lots of different words, and we read about it in the paper or here in the media. But these are all words that we would have heard at various junctures throughout 2020. You talk about a bear market and the negative falls for stock markets. So a bear market is actually a fall of 20% or more from a high. So for example, we would have hit a bear market in just 16 trading days from the 22nd of February into March. And I have another slide on that as well. A correction, not quite as bad as a bear market, seen as a fall from between 10 and 20% from a high. So for example, if any of you remember the last quarter of 2018, that would have been deemed a correction. More than 10% fall, but not quite the 20%. A recession, something we all remember here in Ireland in terms of our experience about 10 years ago at the moment, but recession is technically actually a fall in GDP for 2 successive quarters. So we would have seen that in Q2 and Q3 of 2020. Interestingly enough, Ireland will actually end up being one of the best performing economies in the world on a GDP basis for 2020. However, as many of you are aware, that's kind of skewed by the multinational activity here in Ireland. The converse of a bear market is a bull market, a rise of 20% or more from a low. So you would have seen from Jonathan's charts there, we're actually in a new bull market as it stands. We are up more than 20% from a low, and markets, for example, hit new record highs yesterday for the global stock market. And what would you call COVID itself? You'd actually refer to it as a black swan event. Something completely unforeseen. All the statistical modelers, all the quantitative traders, in terms of the statistical analysis they do, this was not something that was kind of in the investment spectrum. I wouldn't say once in a lifetime event, but certainly a very, very rare event. And in terms of the impact of that, if we just move to the next slide, we talk about things like volatility quite a lot. There's something called the Vix Index, which is kind of, I suppose, it's seen as an option of looking at how we look at volatility for stock markets, somewhat of a proxy, you might call it. So again, as Jonathan said, I know we're talking about 2020, but a 5-year view is kind of helpful here as well. Essentially what this is showing, as those blue bars get higher, there's more volatility in the market. And you can see just there, just past the 2019 mark, at the end of 2019, you see that huge spike in volatility we saw in February and March. That came down very, very fast as well as we moved throughout the year, but volatility in general does remain elevated. Why did we see such heightened volatility? It was this black swan event, and it was the fastest bear market ever. So I mentioned that kind of idea of a fall of 20% from the peak. It took just 21 calendar days, as you can see on the very top of this chart, for us to reach a bear market in 2020. And that was actually just 16 trading days if you take out the weekends. For comparative purposes, if you look about halfway down the chart, you see in 2007, it took 274 days, and the dot-com bubble, 2 below that, it took 353 days, almost a year. So really, really volatile time, a very fast, sharp, volatile time. And again, if I just wanted to bring you to the next slide, which shows one of the most volatile weeks, in history. And you'll remember the now pretty famous speech from the then Taoiseach Leo Varadkar on the steps of the residence in Washington, D.C. as we visited President Trump for St. Patrick's Day, announcing the potential for a first lockdown in Ireland. Well, this is what was happening that week in stock markets. I used the S&P 500, a decent proxy for the US market, which is a decent part of the world, which I'll show later on, but huge up and down days, and negative 12% the Monday before St. Patrick's Day and the Tuesday. The Friday before that was nearly a 10% up day. So again, it felt quite volatile for everybody. We all had lots of other things going on in our lives, but investment markets truly were volatile for that period in February and March. However, that period on the 20th of March was actually just after St. Patrick's Day, was the low for stock markets. And we've seen a really, really strong recovery since then. So just to kind of touch on a few reasons why. And this is our view from Zurich. Everybody has a view, but some of these are pretty well established. The makeup of the stock market is really, really important. And what I mean by that is, if you think of an economic lockdown, we haven't seen this in modern society ever. It's been 100 years since we've seen a pandemic of any sort in terms of a global pandemic. But if you look at the types of companies that are most affected, there'll be small, medium enterprises, SMEs, bedrock of the economy globally, and no more so here in Ireland. However, they might not have robust supply chains, more of a localized customer base, won't have an online presence, and might not have access to working capital and capital markets in general. So they'd be most affected. However, when we look at the make of the stock market, the SME part of the economy is really important, but they're not on a stock market. Once we look at the kind of companies that we see in equity markets, will tend to be a bit more robust, have access to funding and so on and so forth. So a bit of a technical point, but you always remember when you're investing in stock markets, you're buying a slice of equities, not necessarily the entire economy. And at times, equities versus the economy can deviate, and we saw that in 2020. Stocks are forward-looking. As I said, just as we were entering the lockdown in Ireland, equity markets had actually hit their low. They'd hit their nadir at that stage. Because stock markets are forward-looking. They're great discounting mechanisms. They hate uncertainty. So we didn't have certainty by any means in March, didn't have full clarity by any means, but stock market and stock market participants started to look through the bad news and out the other side of a reopening of the economy and vaccine rollout, so on and so forth. So you're not buying just this year's profits when you invest in stock markets, you're buying next year's, the year after, out 5, 7, 10 years. Jonathan stated already, but it really was the big thing in markets in 2020 was the action of policymakers. Both monetary policy, when we look at, say, central bank activity, and then fiscal policy, on the other hand, which would be more government activity. I won't go through all the measures, but it was very quick and very large is the summary on that. You'd be talking about rounding to the nearest trillion with a T in terms of the money that was deployed by policymakers. But the last point of this slide is a key one as well, is there'll always be winners and losers. We're seeing the next iteration of the economy being borne out by the consequences of the COVID pandemic. And whilst the stock market was actually positive in 2020, as I'll show now in a second, there was huge disparity in terms of sectors or the different types of companies on the stock market. So if I look here on the left-hand side, you've got the likes of technology, consumer discretionary, communication services. They're the types of companies we were kind of heavily invested in Zurich in 2020. And what we're trying to do there is you're trying to capitalize on companies that can build on the trends of work from home, play from home, and deliver to home. Okay, so there's some very obvious winners in that, such as the likes of Zoom or Amazon or whatever it might be. But there's also other companies like delivery companies, so on and so forth. On the other hand, we had the likes of energy and real estate that had very negative years. So just what are some of the lessons learned? Volatility creates opportunity for agile businesses. If you're flexible in your approach, if you have the ability, the management speak is, I hate this word, but pivot somewhere else in terms of your business activity, that can be very, very helpful. The market, as I said, great discounting mechanism, relatively efficient. You can argue how efficient, but it will reward winners and punish losers in inverted commas in terms of different businesses. And I know Jonathan will discuss this later on in terms of financial planning in general, but sticking to the plan definitely proved beneficial in 2020. I know hindsight's 2020 as well, but sticking to that plan proved really, really beneficial. So that's kind of a whistle-stop tour. Interest rates is something I didn't quite touch on, but I'll just hand back to Jonathan now, who's going to kind of go into that in further detail, because that was a really key point for what we saw in terms of the outcomes for 2020.
Thank you very much, Ian. So what we're going to speak about now is 6 themes, and Ian and myself have challenged ourselves to have 3 minutes a maximum for each theme, and we'll go back and forth. I'm going to speak about interest rates first and foremost. At the moment, there is significantly low interest rates globally, and they have already been low, but with the onset of COVID, they've been slashed by central banks across the world. The famous economist John Maynard Keynes, his whole theory was that at times of economic despair, that's exactly when you should stimulate the economy. And that was the great lesson from FDR back in the Great Recession in the 30s in the US. It happened again after the financial crisis in 2008 in the US and globally, and now it's happening as well. So by central banks implementing an accommodative low interest rate monetary policy, they're reducing borrowing costs. They're also reducing savings rates so that people are encouraged to invest and spend. And that has the impact of reducing bond yields, both government bond yields and corporate bond yields. And all of this extra cash in the system, if you think about it, that has to be put to work to create inflation at some stage. And it is going to be the necessary evil of what's going to happen as a result of all this extra stimulus. They use the expression, the Goldilocks scenario, where you want an economy running not too hot and not too cold. At the moment, it's running too cold. They want to heat it up a bit, and they don't want to overheat it, but that might be unavoidable. And that's where investors need to be conscious of protecting against inflation. So in the US, the total supply of dollars has increased by about 3 trillion in 2020, which is about 18% of the total dollars in the system. The Federal Reserve have been quoted saying that too much stimulus is better than too little. To give you an idea of the actual bond yields available, a government bond yield with Germany, the German bond for 10 years, you will have to pay Germany less than 0.5% per annum. Sorry, 0.5% per annum. A 30-year bond yield in Germany, you will have to pay them 1/8 of 1%. The US rates are a bit higher in terms of forward-looking treasury yields at about just over 1%. What this means for savers and investors is that banks in Ireland are now either charging negative rates or they're imposing current account fees or limiting deposit amounts. This means that in terms of looking forward over the next 5 years, the risk-free rate of return is now 0 at best. So therefore, projected investment returns need to be made a bit more realistic in the context of having a risk-free rate of return of between 0 and minus 0.65%. Looking forward, I mean, I expect rates to stay the same throughout 2021 globally. The US are most likely to act first in terms of increasing rates, and I think that's kind of priced in if you see the 10-year treasury at 1.1%. So inflation is seen as many as inevitable in the future, and increases in interest rates will follow future inflation. So inflation will come about by not just the quantum of cash that's in the system, which we know is very high, but the velocity of it moving through the system. At the moment, there's very little velocity because there's no activity happening in the economy. But when lockdowns end and when the vaccine is out there fully, and the velocity of money moves through the system, then we could see a rapid amount of inflation. That's something that's very important for investment portfolios. I'll now hand back to Ian to speak about growth versus value.
Thanks, Jonathan. I could talk for hours on this one, let alone 3 minutes, but I'll try and keep to it. Just again, to give you a little bit of an idea of some phrases and themes that we see in the market at the moment. A big one is this idea of growth v value. But just again, to start with some definitions, there's lots of different ways you can categorize companies in the stock market, and these are 2 broad buckets. So a growth company would be one that's growing, as it says on the tin, but they're expected to have future profits increases. They're not quite at full market share. They're aggressively redeploying or reinvesting their capital. They're not giving out huge dividends, this sort of thing. So on the other hand, you have more value-orientated companies. Think of them as more potentially mature companies, the likes of some utilities, telecoms, that kind of, you know what they do. They have their market share. They're not going to shoot the lights out in terms of growing profit, but they give you a nice dividend and they're supposed to be fairly stable. Over the last decade, really, we've seen this kind of disparity between growth v value. And again, I just have the chart here in 2020. The blue line is what we would call growth companies, and the red line would be what we call value companies. So again, if you remember back to that sector chart I showed a few moments ago, and the idea of technology and more internet-based firms and this sort of thing would be in the growth category, while some firms like real estate, utilities, energy might be more in the value category. Now, we saw that play out in 2020. At Zurich, we call ourselves style agnostic. We don't have a growth v value bias as a fundamental view. We do favor one over the other at times. But we saw that very, very clearly in 2020. However, there's this idea, if I just come to the next slide, about what's known as stock rotation. And we might see a difference in 2021. So we might see, as the economy opens up again, you might see some of those companies that didn't do quite as well catch up, and the companies that went really, really well in 2020 not do quite as good in 2021. Zoom, as we're on the platform, is a pretty good example. Had its IPO, its initial public offering, back in April 2019, and it's grown very, very strongly since then. However, Zoom has fallen off a little bit since the autumn. It has recovered a bit this year. But for example, the day that Pfizer announced their vaccine, the Monday after the US election, Zoom fell about 15–16%. What's happening there is a vaccine is announced. The stock market foresees the reopening of the economy, more face-to-face meetings, less Zoom meetings, less Zoom licenses, less Zoom profit, lower Zoom share price. And that all happens in an instant, in a couple of moments on the stock market. So again, just a very quick overview there. You do have growth v value. There's good companies in both categories. It's a very broad stroke. but there is a general idea that value stocks might start to do well with the reopening of the economy. It remains to be seen whether that plays out fully, but it certainly could be something to keep an eye on in 2020, or excuse me, 2021. So look, another thing that also to keep an eye on is ESG investing. So with that, I'll just pass you back to Jonathan.
Thank you, Ian, for that very informative overview of growth versus value. A big theme at the moment is ESG investing, and I'm going to spend a few minutes just talking about that and how relevant it is going to become in 2021 and going forward. The E stands for environmental, so when fund managers are allocating funds with an ESG bias, they need to consider the environment, land, air, water, ecosystems, that type of thing, and generally the carbon footprint of the companies that they're going to be investing in. Sustainability, preventing pollution, all these things are very important in terms of a scorecard that a company may have on its environmental impact on the world. The next one is social, so how does a company contribute to society, human rights, health and safety, culture, morale, that type of thing. And lastly, governance. So what governance mechanisms in terms of diversity, inclusiveness, shareholder rights, all that type of thing are being factored into funds that are invested in. So I suppose as an investment manager from Compass Private Wealth perspective and from Zurich's point of view and all other managers, why do investors focus on ESG? Well, one reason is that investors want to know that the impact of their investments and the role of the assets they play in certain issues such as climate change. They want to have a positive contribution towards society. And also in recent times, there's been more and more evidence that an ESG type of portfolio or fund may actually outperform the broader index on a more consistent basis. There had always been the view that if you're going to be having an ESG bias, you're going to be giving something up, but that looks like it's rotated over the last while. How do fund managers implement ESG strategies? Well, the first obvious one is quantitative analysis. So they're looking at what percentage of the revenues from a certain company come from certain tobacco or whatever it might be. The second, third ones, specialist software and scorecards. So there are certain companies out there that provide the analysis and vet all these companies, not just on a one-off basis, but on a regular basis. Active ownership is also very important. So rather than a fund just passively investing in a company it deems to be ESG, to have a high ESG scorecard, having active ownership, and Ian and myself spoke about this in preparation for the webinar, and say what Zurich do and what a lot of fund managers do is they're active investors, so they vote at the AGMs or the EGMs, and they actually have an input into the ESG output of the companies. So also you can implement rules-based, so if you're saying I'll invest in a company provided it has no more than X% in a certain type of revenue. And it's important as well that when allocating capital with an ESG bias, it's not all about finding a brochure for a fund to say, this is an ESG fund, so therefore I'm going to invest in it. Some fund managers have an overarching bias to say that everything they invest in, they'll have a scorecard, they'll have active ownership, and they'll implement all of these ESG measures more on a holistic general basis as opposed to a fund-specific basis. So now I'll pass back to Ian, who's going to speak about the next theme of investing with the long term.
Thanks, Jonathan. And I think this is really opportune time to do this. I think there's lessons to be learned from what we saw in 2020, and whilst that's still fresh in all our minds, just to go through a couple of key principles. So to just go to the first slide, which I do appreciate looks very busy, but I can hopefully explain it well enough. So this just shows large cap, which is equities, bonds, and then a 50-50 portfolio. And it shows those three types of investment over 1, 5, 10, and 20 years. So I'm not going to go through all the figures on the screen. But for example, if I look at the very left-hand side, the dark blue, since 1950, this particular chart, The most you could have gotten one calendar year was 61% from equities. The worst was 43%. For bonds, it was plus 48 to minus 18. And then obviously the 50-50 portfolio is somewhat in the middle as well, okay? I won't go, as I said, go through it all, but you'll notice two things that happen as you move from left to right on this particular chart. The range of returns gets narrower, okay? And it also skews or moves upwards. So what does that tell us about the long term? You have more certainty the longer you invest. You can see how narrow the bars are in 20 years versus over 1 year, and they're also above the zero line as well. So again, we all know this, but it's just to kind of show it in graphical form that we know diversification helps to reduce risk, and also that long-term investors get rewarded. Second kind of theme to think about is trying to time the market. We always, this old adage of time in rather than timing. And this just shows the value, I've used the MSCI Europe, but it actually works across most stock markets. If you were fully invested from 2003 to 2017, if you had 10,000 euro back then, it would be worth about 17,000, 18,000 euro today if you'd stayed fully invested. However, if you've missed just the best 10 days over that 14, 15 year period, you would have halved your return. You would have actually got less back than you put in. Missed the best 30, lower again, missed the best 50, lower again. This is really, really important because it's about staying the course and sticking to the plan. When do we see the best days? Usually after the worst days. And again, 2020 shows that perfectly for us. From the low in late March through April, that was the best 50 days ever for the US stock market. So again, people who look, moving to cash or de-risking can be part of a plan depending on your own circumstances. But some people who moved that out of markets would have missed that best 50 days ever. And again, that means they're probably not back at record highs like we are across the market in general. So again, don't try and time the entry and exits and kind of stick with the plan. Another key point in that is this idea of behavioral biases. So biases aren't to be looked, they're not to talk disparaging about them. Everybody has biases. I have them, Jonathan, Angela, everybody has them. But it's just being aware of them because it means you can counteract them in times of stress. So these are just 4 I have on the screen. I think I listed out 50 in one conference I did, which you'll be glad to hear I won't be going through today. But just very quickly, loss aversion. We all prefer avoiding a loss than getting a gain. Think about that in life. What's losing a tenner worth versus gaining a tenner? Confirmation bias will look to confirm pre-existing beliefs from the market. Herd mentality, what's the person who you sit beside and work or the next door neighbor doing with their investments? Should I be doing that as well? And anchoring bias, we rely too heavily on the initial piece of information. This is a great one in COVID as well. COVID was very, very bad, is very, very bad, was bad for stock markets. But if people didn't let new information come in and parse that information throughout 2020, you would have had that anchoring bias by thinking that stock markets were still very, very poor. And the media doesn't help sometimes with this. Bad news sells, as we all know. So again, just be very aware of your behavioral biases and stick with that plan, stay invested and stay invested for the long term. I think there are some lessons from 2020 for investment markets. And that probably brings us, I suppose, through to the next point quite nicely about how you take some of those things and implement a pension or strategy investment with them.
Thank you, Ian. So I'm now going to speak about how to implement a pension or investment strategy. The first thing before anybody decides to invest capital, or if they have an existing portfolio, but just to go back to basics to say, well, why would one invest their capital in anything outside of cash? Well, it's ultimately to generate growth in capital or income in excess of the risk-free rate of return. So as I said earlier, that is now currently 0 or minus 0.5%. If interest rates are higher, and when interest rates will be higher in years to come, that rate will be maybe 2%. So you'll say, well, I want at least 3 or 4% for my investments to justify moving money away from cash. Also, you invest your capital in order to avoid the real value of your money being eroded due to inflation. So again, if we see inflation in years to come, which I do anticipate at some stage, you want to make sure that your funds keep up with that, and they may not keep up with that if they're 100% in cash. To fund your retirement years, so by default, when somebody retires, their earned income ceases, and therefore they become dependent on the state pension potentially as a staple, but also on their savings and their own private investment funds built up. So you want to make sure that you grow your capital to an extent to fund your retirement. Also, as a succession plan for the next generation, so to make sure that if you have surplus capital, and if you've got children and grandchildren, you're in your twilight years, that ring fencing a portion of your assets that you know for definite you won't need in your lifetime. Well, that actually ironically does, that portion of your capital has a long-term investment view. So one can afford to take a bit more risk with that and ring fence it as a succession plan for the next generation. When should you not invest? Well, if your financial circumstances or personal preferences dictate a low tolerance for risk, appetite to risk, or capacity for risk. So again, make sure that you're only investing capital that you have a longer term investment time horizon, that you have the appetite to risk. And we probably scared you a bit by showing you charts of what happened in 2020, but one has to expect that those types of falls and that level of volatility is always going to be expected, at some stage in the next 10 or 15 years. So you need to be able to accept that if you were to allocate funds outside of cash. How do you diversify? So does somebody take all their cash and say, well, I'm going to put it all into the US stock market because the US market was positive last year? Absolutely not. You need to say, well, I'm going to keep some element in cash and I'm going to diversify my exposure across a number of different factors. And here are the seven main ones we look at to make sure that your capital is split appropriately so that the risk score is suitable for the risk questionnaire that you've completed, and it's also consistent with your financial planning objectives. Diversifying, it's free and it's so important. I saw when I joined the industry first, unfortunately in 2017, 2018, an overly reliance on bank shares in particular, mining stocks and some leveraged property. It's unnecessary. So to make sure you're as diversified as possible, to reduce your risk and to smooth out your returns over the years. Your level of risk depends on your age. It depends on your personal risk profile, which isn't really quantifiable. It kind of comes out in a risk questionnaire. Having unnecessary leverage for investing is absolutely mindless and nonsensical, in my opinion. One should only borrow money for their own home if they're taking out a mortgage, or for other reasons, maybe to do with their company, but investing by taking out debt unnecessarily should always be avoided. It can magnify returns, but it can absolutely wipe you out as well. And also, the level of risk depends on your view and the view of your advisor on whether or not markets are overpriced at a point in time. More risk is more exposure to risky assets such as equities and property, and less risk is less exposure and more exposure to assets like cash and bonds. So the final theme I'm going to pass back to Ian is on equity markets scratching underneath the surface.
Thanks, Jonathan. And just to kind of build on one of Jonathan's points there about diversification and not putting everything in the US or Irish property or whatever example you might want to use. So just sticking with the kind of the theme of just information and education on this is, what does the world look like? So this is just a pie chart of global equities. You'll notice anything I've said today, I've talked about the US quite a lot. I haven't discussed Irish stock markets or whatever it might be. That's because 66% or about 2/3 of all the stocks or equities in the world are actually in the US. So again, that's the US dollar piece that we spoke about earlier on. About 13-14%, I have it as EMU, which would be the Eurozone. Another big chunk in Japan. That 9% in other would be generally Asia Pacific, with a bit of emerging markets elsewhere in the world, and only 4% in the UK. So just kind of 2 points to make on this particular chart is, firstly, the US matters massively for stock markets. At Zurich, we think about that quite a lot, about currency exposure, because lots of other currencies are highly correlated to the US dollar as well. But on the flip side, if I look at the UK market, it's about 4.5% of the global stock market. Ireland's about 0.4%. If we look at the companies in those stock markets, a lot of them are big global companies based overseas, the likes of CRH or BP in the UK. Also looking at the sector breakdown, this is a bit of a busier chart, but technology on a global basis is 22% of the stock market. So when you look at the top 10 stocks in the world, you'll see these kind of FANG plus Microsoft stocks. And they are the biggest in the world because that's the growing part of the market in terms of technology. And you've got all the different sectors globally listed there. There are good opportunities across the board. Real estate is a very, very differentiated market based on different jurisdictions. Energy also includes fossil fuels, but it also includes clean energy companies as well. So we're heavily invested in some of them, for example. But just looking at when you see you have a lot of tech or consumer discretionary in your global portfolio, what are you comparing that with? It's always relative to what we're seeing across the world as well. But also geographical and sector breakdowns are important, but we also need to look at where companies make their profit. So again, if I just use that example of the FANG plus Microsoft, so Facebook, Alphabet is the parent company for Google, Amazon, Microsoft, and Apple. Profits from outside North America, Facebook, Alphabet, and Apple actually make more money outside North America than they do in. Amazon and Microsoft a bit behind, but still a big chunk of money. So again, you might be looking, I've got too much in the US or too little elsewhere, but you need to look under the surface and see where those companies are actually making their money. And the last slide for me on this is this idea of market concentration. The percentage of the market that the top 10 stocks take. Okay, so if I look at 1930, the top 10 stocks in the market were 27%. At the start of 2020, it was about 22%. That's actually risen since. I haven't updated that in 2021. But my point is some of these mega cap tech stocks are getting bigger and bigger, and it's something we're definitely aware of at Zurich, but history tells us an awful lot as well. How does that stand up relative to what we've seen in the past? And again, it is elevated at the mid-20s, but we have seen it higher in the past. And market concentration in that respect has kind of always existed. So look, that's the last little segment from me, but just a little two or three different bits that you might hear sound bites in the media about stock markets, but underneath the surface, there's a bit more of a story to tell.
Thank you very much, Ian. We've a few questions that have come in, and if you do have any other questions, just go to the Q&A button and submit them to us. I'll speak a minute or two here on summary, and then I'll go straight into a couple of the questions which I'll put to Ian and myself, and we'll probably go slightly beyond the 45 minutes, but obviously if you have to go, then just sign off. We'll be sending the full recording anyway, so you'll be able to pick up on any Q&A questions that you may have missed. So the key points for any investment strategy, to summarize: diversification. Always look holistically. Don't just look at your pension in isolation. Don't just look at your personal funds in isolation. Look at everything. And if you're married or you have family assets with trusts, look at everything holistically. Be clear with your mandate. You know, my pension, I want to invest this in equities, or I want to invest my personal money in this asset class. Ultimately work with the likes of us in terms of setting out that clear mandate. Make sure you understand your investments. By default, when an investment is regulated, it means that there's an onus on the advisor and the firm to provide a clear level of transparency, so you get it by default with a regulated investment. But always make sure that when you allocate capital to anything, make sure you fully understand it. Inertia, so if the outcome of a financial review with the likes of us says that you should do X, Y, and Z, oftentimes we feel that paperwork and moving assets and setting up accounts, all that can actually distort the plan because people don't seem to have time to do it. Don't fall into the inertia trap, just get it done if it's appropriate for your financial circumstances. And always avoid conflicts of interest. So don't ever, I suppose, give a mandate to, I suppose, an investment advisor who has a conflict of interest whereby their advice might be for you just to invest the money if it's not appropriate for you to do so. When it comes to holistic planning, look at step 1, understand your existing financial position. Step 2, ascertain your financial goals and objectives. And then step 3, you take 1 and 2 together and you implement the agreed asset allocation objectives. As a lot of you on the calls know, a lot of clients here, a lot of professional referrers, Compass Private Wealth is running this webinar series throughout 2021. We're open for business. We love meeting new clients. If you have any colleagues or friends who you feel will benefit from speaking to any of us in Compass Private Wealth, please do reach out. We'd be very appreciative. At this stage, I'm going to put the first question to Ian. I'm going to stop sharing, and Ian and myself should be visible now. So Ian, a question came in here specifically in relation to growth stocks, and you mentioned a sectoral rotation. But do you think that the onset of COVID has meant that there will be no rotation, that we're permanently in a technology-focused, stock market weighted index going forward, and that actually the value stocks may never come back?
Yeah, there's a couple of ways of looking at it, and it's the $1 trillion question. Our view would be that 2020 saw an acceleration of trends we thought might happen across the whole decade. So my own company in Zurich, we were going to trial working from home throughout 2020, and by mid-March we had the whole company at home. People, their hand was forced in terms of change. So the economy it's going through the next iteration. There will be winners and losers. In terms of tech being the biggest sector, oil companies were the biggest sector in decades gone by. Financials were, telcos were before. Like telecoms in the early 19th century were the tech companies today. There's always innovators. So tech can lead. Bigger will get bigger in terms of economies of scale, but never completely write off something. We wouldn't write off value stocks. It's an open mind, I suppose, but tech can continue to do well, just given how much we're using it, how much it's here to stay. But there's always opportunities across the whole market.
Thanks for that, Ian. The next question here, how do you protect your portfolio in an inflationary environment?
Yeah, another good one. Our view would be we'd agree with your own view on interest rates, certainly not getting higher in 2021 and probably looking at late 2022, all things being well. So we're not there just yet. Inflation, if you look at technology gains and productivity per worker, all this sort of stuff, we're not seeing a lot of inflationary pressures. So it's a question for some time, maybe not today, but in terms of that question, assets that give you good yield, if you've got good property with good rental yield, again, that's quite individual. Equities will do well in inflationary environments to a point, and then cash becomes a viable alternative. Gold can do well, even though it doesn't have a yield, it can't have a negative one. So as yields pick up, gold can do okay. The big point I'd say probably is things to be aware of on the downside would be bonds. So longer dated bonds, like those 10 or 15 or 30-year bonds you discussed earlier, they won't do well if inflation picks up. So again, looking at how your bond or your fund manager has their bond portfolio positioned is important, because shorter dated bonds will provide better protection in inflationary environments. But there's a few different ways of looking at it, yeah.
Thanks, Ian. One other question which I might answer the start of and pass on to you then, Ian, it's about timing risk. How do you avoid putting all your money into the market at once? I suppose my answer to that is phasing money into the market. So if as a result of a financial review, there's a sum that you have decided to invest in the market, either through your pension or personally, then in my opinion, you'd be better off maybe splitting that into 2 or 3 or 4 different tranches, depending on the amount and depending on the logistics, and phasing that in on a gradual basis. Because what happens in that case is that if markets do fall, you're buying in at cheaper rates. And yes, there's a risk that markets increase and you're buying at a higher rates, but I think from a financial planning risk minimization point of view, I think allocating money in on a gradual basis. I'm not sure what your thoughts are on that, Ian.
Yeah, so the maths is inconclusive on this, whether just doing the lump sum or whatever, but more importantly is the behavioral side, the steps into the pool rather than off the diving board kind of idea. What I will say is, just to your exact point of inertia on your last slide, if you do decide with Jonathan or Angela to drip feed in 3 lots in the next 3 months, stick with the plan. When you decide that on day one, no matter what happens, do it, because there's always going to be a reason not to invest. So whether you do the lump sum or you do 100% in 6 months or a third, if you agree with that, just hold yourself to it as an investor.
Ian, thank you very much for that, and thank you very much for coming on to this webinar with us today. Thank you to all our guests for logging on. We will send you a feedback form, we'll send you the recording, we'll send you the slides, and we'll also send you an invite for our webinar next week. Thank you very much, everybody, and stay safe.
Thank you. Bye-bye.